wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Welcome to you, my family of wealth builders. This is episode 8. They lied to you. Not why covered calls work. So Bobby is going to kill me. Literally yesterday, Bobby, who is our producer, asked me for the titles of the next 3 episodes, and I gave them to him. But, well, I got this crazy idea for this episode that it's more fun and kind of more insightful to do it a little bit differently, and I think you're going to like it and get a lot out of it. So, yeah, I lied to Bobby, but it was an accident. Oh, and incidentally, I lied to you too, but that was an accident too. I mentioned on the last episode, this one was going to be why covered calls work. And I'm actually going to share that right at the start here in a minute. But as I was writing the chapter of this book that this episode is based on, I realized in order to understand why covered calls work, it's really important to understand why they don't work, or specifically to understand that some of the reasons you hear people say that they work are completely BS. And we all know what that stands for. You, my friends, have been lied to, and I understand why. I don't think it's malicious or anything like that. Probably not at all. It's for a worse reason than maliciousness, I think. It's intellectual neglect. Plain old not trying hard enough. And that, my friends, my wealth building family, that is inexcusable. If you walk across the street with your eyes closed 10 times and don't get hit by a car, does that mean there aren't any cars? Well, this is what a lot of options investors, even the ones with YouTube channels with lots of subscribers, seem to think. Covered calls work for a couple reasons. The main one is that statistically, overall, options are usually overpriced. We're going to devote the whole next episode to that concept, the one after this. But the false logic that too many traders use is not about that at all. When most people trade covered calls, they sell out of the money calls. And there's a natural feeling of benefit from that. They have a high probability of being good trades. And when some traders have good experiences trading, you know, like walking across the street blindfolded without getting hit by a car, well, they think they're making good trades. And they might be, but they might not be. Now, before we jump in to what's going to be some stuff that I find really interesting, I first need to ask for your help. Please help me grow the Wealth Building with Options community by doing 2 things. First, please share this podcast with like-minded people. That helps you. You'll have someone to bounce ideas off of, someone to teach so you can learn. And it also helps grow this community. Word of mouth is super important. We can only promote this show so many ways. And the best way is to grow our community organically, just by simply telling people about it more often. The second thing you can do is please do me a favor and leave a review on Apple Podcasts, Spotify, or whatever podcasting platform you listen on. That helps us so much. It helps the algorithms push out the content to more people. If everyone could leave 1 review, I think we can make it to being one of the biggest options investing podcasts there is. And when you post a review, I want to return the favor and give you something great. So here is what I'm going to do. If you are listening to this episode, please, please, please leave a review on Apple Podcasts or Spotify or whatever you listen on. And after you post your review, take a screenshot of the review and go to either our social media or our Substack and follow us and post the screenshot of the review there on social media or Substack and just leave the hashtag WBWO, Wealth Building with Options, and that'll enable us to see it. So just pound or hashtag WBWO, leave the screenshot of the review, and we will send you the covered call strategy guide PDF for free, just for posting a review. The links to our Substack and our social media are all in the show notes below this episode. I thank you for it in advance. I really appreciate your help in growing our community. Now, let's talk about what they lied about. The commonly held fallacies about covered calls. It's common for covered call investors to sell out of the money calls in which the strike price is higher than the stock price. The advantage that this method of implementation of covered calls sometimes has is that the underlying security must rise in order for the stock to get called away. And that is true and certainly can be an advantage. But oftentimes the misdirected focus is on the call component of the trade, and that it has this head start on being quote unquote right because it's out of the money. In this line of thinking, being right is high probability. And such, if the stock remains below the strike price, the call expires, the investor keeps the premium, you win on the call. But what about the stock? Well, other times, the over-magnified focus is indeed on the underlying stock itself. The concern is that even if you win on the call, you have much more risk on the shares of stock, and the premium on just this one call is too small a credit to matter. And so then still there's the opposite side of stock-focused apprehension. If the stock rises through the strike price and gets called away, the investor leaves money on the table. I will argue that this overweight focus, worrying about leaving money on the table and worrying about the stock going down too much, they're short-sighted reasoning as much as focusing just on whether the call wins or lose. So let's go a little deeper. Academics, as well as many what we call quant practitioners, and a quant is just somebody who is a trader but is also like a mathematician and a programmer, and they come up with all this fancy math to make money trading. So academics, as well as many quant practitioners who study options, they model stock price movement with the assumption that stocks adhere to a leptokurtotic normal probability distribution curve. Holy cow. Now that is a gigantic mouthful. Oh my gosh. Let me say that again. So academics and quant practitioners, they study options, they model out mathematically stock price movement with the assumption that stocks adhere to a leptokurtotic log normal probability distribution curve. So let's break that down just a little bit here, okay? A log normal distribution implies a few things, but mainly it implies that smaller moves or deviations from the average price are more observed or more probable than bigger moves. The leptokurtosis part means that the really big and highly unexpected moves in what we call the tails actually occur in the wild much more frequently than a standard log normal distribution curve would indicate. This same curve can be used to model expected future price distributions as well. So, what does this mean for these out of the money covered calls? Well, what if I was to plop a probability curve over a P&L diagram of a covered call trade, like we talked about in the last episode? The horizontal axis is still the stock price for the P&L diagram, right? The horizontal one is just the price of the stock. And that is also the same for the log normal distribution curve as well. As for the vertical axes, again, it's the profit or loss for the P&L diagram, but there would need to be like an alternate vertical axis for the probability curve. Its vertical axis would indicate the probability of the stock being at that particular price. Okay. Again, let me say that again. For the probability curve, the log normal distribution, its vertical axis would be a different set of numbers. It would be the probability of the stock being at that particular price. So if you think about just picture a bell curve if you're not familiar with the log normal distribution. In the middle is the average of all the closing prices from the past, say, 30 days or whatever. That would be the most probable because it would be the highest point on that vertical axis. The more unlikely, very big moves up or down, those would be lower. They would be in the tails on either side of the bell curve or log normal distribution. And so that number would be lower on the vertical axis. Okay. There are many details involved in what the exact shape of that curve would look like the volatility, the scale of the units on the vertical axis, etc. So don't get hung up on that. The concept is that the most likely scenario is a beneficial trade compared with just being long the stock. Okay? Why? Well, like I just said, the highest probability at the apex of that probability curve is the average or the most recent closing price, depending on whether this is an observation of the past, which would be the average, or a model of expectations for the future in which you would use the current stock price. About half the time, the stock would be projected to close below where the stock is now, and that would mean winning, quote unquote, on the call portion that is not being assigned. And there's more of that story we'll talk about in a second. The other half of the time, the closing prices would be above where the stock is now. And some of that time, that means not being assigned on the call and keeping the premium too. Okay, so where do the probabilities for bad outcomes lie? Well, clearly, if the stock falls too much, the trade as a whole loses money. But that's a less probable outcome than staying close to the average price. And if you listen to the last episode, which I hope you did, we were using this example where the stock is at $119 right now. So basically, we're using the log normal distribution to project future prices. So $119 is where the stock is now. If the stock rises too much over the strike price, which is in this example, we'll say it's $122 a share is the strike price. If the stock rises too much and goes over that strike and is over that strike at expiration, well, that's where that darn I left money on the table scenario comes into play. Well, that's a lower probability too, right? That's further away from the center, the apex of the probability curve. So the Goldilocks part is near the middle, obviously. That's the highest probability. It's the more likely outcome. And in that range of outcomes, a couple of good things happen. You keep your stock. It doesn't go down to, if you're close to the middle of that probability curve, that means it's close to the current stock price, meaning it doesn't go down too much, and you outperform the buy and hold strategy, or Better yet, also in this probability curve, if it's close to it, but to the upside, the stock goes up, but probably not above the indifference point, or what we call the indifference point. So let's flesh out this example a little better here. Stock is at $119. We're selling the 122 strike call, and we're selling it at, say, $1.50. I'm just sticking with the same example we used in the last case. So to talk about this thing we call the indifference point, if the stock rises, I mean, the investor is going to feel like a champ having sold this covered call, but only up until the stock got above $123.50. That point can be called the indifference point. That's the point at which the investor would be indifferent as to whether, in hindsight, he or she sold the call. Below there, the investor is happy and feels smart. Above that point, the investor is regretful for having been assigned. Now, instead of thinking about it in terms of being assigned, let's think about it instead in terms of what the call would be worth if it's in the money. At expiration, the in the money call would be worth only and all intrinsic value. So whatever the in the money value the call has, that's what it's worth. The call was sold in this example at $1.50. For the call component to lose, the stock, WXYZ stock we'll call it, would actually have to be above $123.50. The 122 strike call would have to be in the money by more than $1.50. Right? So if you can just kind of picture this, and if you became a paid subscriber and you noticed the video extra where I actually kind of show this to you on a chart so it's a little bit easier to understand. If the stock goes from 119 to 122, great. If the stock goes above 122, well, the stock actually gets sold at 122, so you stop making money on the stock, but you still have that $1.50. That trade becomes a loser once the call's worth more than $1.50. So basically, it's $122 plus $1.50 is that indifference point, that point where above there, geez, I actually did leave money on the table, shucks. Below there, I'm a genius. I outperformed the stock. The stock went up and I made more money than I otherwise would have. Even if the stock is above that indifference point of $123.50 at expiration, overall, this covered call, it would still make money because the stock would make money as it rose in price and would continue to make money as it rises further. It's just that if we're looking at this instead of assignment, but in terms of in the money value, the stock continues to make money above 122. It's just that its gains start getting offset by the call's losses above $122 a share, above the strike price. But when the call loses, a lot of novice covered call traders, they lament, oh no, I left money on the table. They focus on assignment of gains stolen from them or something. But then the ones who focus on the smaller premium of a single call premium, you know, like, oh, I got $1.50, big deal. I still have all this risk on a $119 stock. If it goes to 110, you know, I still lost a bunch of money, right? They have their woes too. They have their problems with it, I guess I should say too. The investors who focus on the middle, where the most likely outcomes occur, and the call solidly benefits the trade, they at least have kind of a more positive attitude. The upside down cup of the probability curve is half full, I guess, right? But unfortunately, they're missing the key point too. So just to recap what I'm talking about here, maybe make this a little bit more clear. There are three what I would call unreasonable worries based on misguided logic among covered call traders. And they're all just plain wrong. The first one is I lose money overall if the stock goes down too much and the small call premium I collect on the trade just isn't worth it. The second one is, well, if the stock rises too much and is through the strike price at expiration, I get assigned and I lose the stock, so I miss opportunity and leave money on the table. And the third one is, and this one is positive by nature as opposed to the first two being negative by nature, but there's still problems with it. Covered calls have a high probability by nature of adding value to the investment, so I should always trade them. You'll hear these a lot. Purge them from your mind. All three. I mean, they're rooted in facts, in reality, sure, but there's one big fact that's omitted from all of these misguided logic progressions. The options pricing model is designed to balance probability and the value of the option. The value of an option is a factor of where the stock price is relative to the strike price, and it's also a factor of how much time is left until expiration. It's a factor of volatility and expectations for future volatility. The interest rate affects it too. These things all combine to form the basis of the value of any given option. So imagine that trade that we were just talking about, where you own 100 shares of the stock at $119 a share. You sell the whatever expiration 122 strike call at $1.50. And let's say that's a real trade. You or some investor, whoever, is looking at it and you think, yeah, this is a good covered call. I'm going to make that trade. Okay. You own 100 shares, sell the 122 calls at $1.50. Well, would you also think it's a good trade if you were selling the call at 50 cents instead of $1.50? Or at $2 instead of $1.50? Or how about selling it at a nickel instead of $1.50? I mean, the price matters, right? But with the sometimes hundreds of option prices listed on just one single stock, the eyeball barrage of flashing prices of this metric crap ton of options can be like a clusterfuzzle to investors who are not familiar with the nuances of what make up their value. And that's really the big thing when it comes to trading. I mean, really trading anything. There's this saying, Warren Buffett saying, price is what you pay, value is what you get. And that's really, really relevant with any type of trading at all, including and especially options. Now, with stocks, if you learned anything about valuation of stocks, and if you didn't, that's fine too. It doesn't necessarily matter for what we're talking about here. But if you're familiar with what a PE ratio is in a stock, price to earning ratio, well, that makes it pretty easy to get a feel for, is this stock really overpriced based on how much its earnings are or are expected to be? Or does it seem cheap relative to where other companies in its industry are, right? You can kind of do that pretty easily without being a financial analyst or anything with a stock, just to get like a relative feel for it. But options are so tricky in that regard because there's so many different forces that affect the value of it, let alone the price. I mean, the price is determined by supply and demand, but that's based on the traders, especially the market makers, the liquidity providers, running valuation models. They're concerned about the value and they set the price around it. But anyway, that's a digression. It matters so much how much you collect in terms of that option premium. And people focus so little on that. And that is what we're going to be talking about in the next episode. The whole next episode is dedicated to that. That is why covered calls work. But I just I wanted to have a whole episode about not why covered calls work, just the falsehoods that people worry about. And it's just it's just so misguided, misplaced, misfocused. You're never going to buy the absolute top. You're never going to sell the absolute bottom, right? If you're selling a covered call to get assigned, we're not worried about that. We do want the covered call to be sort of in the middle, like that one false worry that I said is at least positive. Like, I mean, they're all rooted in reality. Covered calls have a high probability by nature of adding value to the investment, so I should always trade them. But what do you pay for that? Right? So, like if you're going to buy a car because you need it to get to your job and to meet clients in, and you want it to be comfortable and look good. So, you set your sights on whatever car it is, Jeep Grand Cherokee, I don't know, or Lexus, it doesn't matter, right? You set your sights on that. Okay, so you go into the car dealership and you say, yep, hey, look, I did the research on this car. This is the car that I want. It's got all the things, has value to me for all these reasons. And the car dealer guy says, okay, that's great. Well, this Jeep Grand Cherokee right here, it's brand new and you can buy it for $500,000. Just sign right here. Like, you're not going to do that, right? Like, it has value, but the price is not congruent with the value. But if he says, oh, it's brand new Jeep Grand Cherokee, we got a sale for it. I mean, we're trying to get rid of these because last year's model, we're going to sell it for half the price. It's 20 grand brand new. It's got leather interior and all the details or whatever the heck they call them. Okay, I'm in, right? Even if I don't need that car, I'll buy it. I'll just go sell it to somebody else, right? I mean, it's priced less than the value. So even though when the stock remains in the middle of that high probability curve, it does add value to the trade, but what is that worth to you? So that, my friends, that is gonna be the topic for the next episode. And remember, you can help spread the word about this show by subscribing to it in your favorite podcast app. Please do tell somebody about it, leave a review, take a picture of it, post it on our social media or Substack page with the hashtag WBWO, and we're going to send you an ebook. For this segment, I would like to welcome a really special guest, a good friend of mine. He's the Vice President of Market Intelligence at CBOE Global Markets, Henry Schwartz. Henry, can you tell the listeners a little bit about what you do at CBOE Global Markets?
Sure. I've been with CBOE for almost 5 years now. I came in with the acquisition of a data company that I started called Trade Alert, and I moved into the market intelligence team in January. And market intelligence is basically a group of experienced traders and quants who put together content to educate our customers, talk about kind of what's going on in the markets, what we're seeing in terms of order flow, what kind of new products are coming along. I love it because really, I get to dig into the data all day long, which is a lot of fun for me, and also really help people kind of learn to use our products, which I know is near and dear to your heart as well.
Excellent. We've been talking in this episode about some of the reasons why people trade covered calls that are decent reasons on the surface, but they're maybe not necessarily what I would call great reasons, not edge-based reasons. Mm-hmm. The edge-based reasons, as far as I'm concerned, are the risk premium observed in option prices and the concept of selling covered calls over and over again to capture, well, basically the way I look at it as the average risk premium over the time that you have the calls on and you're rolling. But the risk premium, that'll be the topic for the next episode. Okay. So, Henry, you're the guy when it comes to what's going on in the options market. You've got your finger on the pulse more than anybody I know. So let me throw a couple questions your way if you don't mind.
No problem.
What kind of recent studies have you seen coming out of the CBOE on covered calls, and what can you share with us?
Sure. So before I forget, I have to say, these views are my own. I'm not making recommendations, but I do have, 35, 40 years in the business at this point. And, as I said, I pay a very close attention to what's going on in the markets and the kind of studies, academic, white papers, anecdotal that we do on different strategies. And it was really kind of interesting on the buy right side of things. We have a group called Siebel Global Indices, which publishes things like VIX, and we actually have over 1,000 indexes that we publish in real time. About 50 of those actually are buy right indexes, meaning a very systematic framework of taking an index, typically an index, although we actually do have some, I believe, for some single stocks, and then basically tracking, well, what would the performance be if you repetitively sold this type of call, meaning a specific time horizon and a specific moneyness, and then how does the performance look? And in terms of buy rights, I mean, it's one of the oldest strategies, right? I mean, options have been around for 51 years now, 52 years, I guess we're going into. For the first 5 or 6 years, there were only calls anyway, right? They didn't list puts until 1977. So stock and calls were the only two ingredients you had, and buy rights were one of the very first things that people began to trade because it's kind of, there's a comfort level there, right? Like, okay, I own IBM. I've owned it for a long time. I want to add some yield, or I have a view that it may go up from here, but it may not go up. I don't think it's going to go up above whatever, $110. And if it does, I'm actually comfortable giving away some of those gains because I get to keep it right up until that strike price. So in general, the studies that I've read, buy right strategies tend to perform, there's periods where they perform better than others, right? Because effectively you're buying the underlying, right? You're taking 100% risk of owning the underlying. However, that's what most people do when they have stock in a brokerage account or a 401k or whatever else. And you're selling an out of the money call, meaning you're going to keep some of the gains, you're going to collect some premium for the call, and you are not going to participate in gains above that strike price. A consistent repeating buy right strategy tends to perform similar to the holding the underlying with a little bit better, a little bit less volatility, the drawdowns are a little bit smaller because if you think about it, even if a stock does go down 20% in a month, okay, happens every once in a while, you collected maybe 0.5% or 1% in the sale of the call. So you're going to do a little better than somebody that hadn't sold the call. If you're in a stock or in a market that's exploding to the upside and you've basically given away or sold off that upside, you're definitely going to underperform. So if you look at the buy right index, I was checking it out before the show, we have a bunch of them on S&P, on the S&P 500, because that's Cboe's flagship product. One's a 2% out of the money call that is sold repetitively. There's one that sells the call, but only half the size of the portfolio. There's a lot of different flavors on it. They're actually doing very well this year because this year, basically, the market's flat and volatility has actually been kind of elevated. So you're collecting a pretty good amount of premium and the market's not rising up through your strike. In general, the call you're selling is going out worthless and the underlying you're holding is just kind of trading in a range. And so you end up having lower volatility, the drawdowns are a little bit smaller, and it performs really well in sideways markets. And even in markets that are declining, it performs better. You have risk in a super strong upside market that, if you were doing this in 2020 and 2021, when we were bouncing off the COVID lows and the market was going up 30%, you really would not have participated in it. So people, I think, in my view, it is a strategy that absolutely has a place. It's not the one and only strategy that anybody should do. When you have a conviction on a stock or on the market, and you're comfortable putting some capital at risk, it's a great way to enhance the returns and, like I said, kind of dampen the volatility if things do get choppy.
Interesting. I wonder if you've seen any evidence as to, is it better to sell far out of the monies or at the monies or in the monies? I don't know. Have you seen anything like that?
I haven't seen anything. It's a good idea for a really nice comprehensive paper. The reality is, until recently, right, really until the last few years, the liquidity was pretty poor on a lot of the market, especially the lit liquidity. Meaning, if you and I said, "Hey, listen, let's talk about Roku." Okay, I like this stock. I want to hold on to it, but I want to sell calls. Well, the performance, like back testing something like that, is kind of tricky in that you need good liquidity on the quote so that you have a quote to say, okay, well, today I would have sold it for $1.25, and then time passes and whatever your strategy is, whether you close it when it gets down to a nickel or a dime, or whether you wait for it to expire, if you don't have decent quote quality, you're going to get pretty ugly results, because maybe the market was 70 cents at $1.50, and using 70 cents is a pretty terrible price, and it's an awfully wide market. Using the midpoint is also maybe not super realistic. So like that, you end up. So what I'm trying to say is, over the last few years, liquidity has improved, right, as the market volume has tripled since 2019, and so most of the academic papers that I see that I see hit SSRN and some of the places, they tend to be over. They're done over the last few years. It's kind of rare to get a really fresh paper, right? Because they got to take the data, they got to do a lot of work. There's peer review and everything else, and it ends up getting published. So I think that it's a great environment now that the quote quality is better, and also the ability to wrangle massive amounts of data, and even use AI in some of the analysis, means you absolutely you could do some really nice studies. Okay, what if I sold a 5% out of the money call expiring in 90 days? I want to compare that to the 6% and the 7% and the 11%, and do some nice interpolation of what if there's no strike at that, the percentage that you're talking about, right? There really is a lot that goes into well, if there's no strike but you could have traded it flex, then you could do a study, and you just have to say, look, we're estimating using what would be theoretical flex prices. We're building in a little bit of slippage, but you have to pull all that together before you can do that kind of a study. But I think the time is right. Most of the studies I've seen are relatively simple. What if I selling a 30-day 2% out of the money call, or 45-day, and then whether you roll it with a week to go. They're all in general, the details matter a lot. But still, the overall feel you're going to get from a strategy like this is going to be nice performance in a sideways market, nice performance in a trending down market as well. And in a strong bull market, you're not going to make as much money as your neighbor who just has long stocks in a portfolio that they never even look at.
Let's talk for a minute about who trades the strategy. One of your big things is where the flow is coming from. Who is trading these, basically. So is this are covered calls and such, is it more professional investors or average mom and pop investors? Do you have any idea what the breakdown might be?
We know that in the market, as a whole, about half of the volume that trades is retail. We're talking the brokers you've heard of: Robinhood, Fidelity, Schwab, E-Trade. That's half the activity. Now that includes things like zero DTE trading, right, which makes up, my makeup about half of that. And then it also includes strategies like overwriting, like, outright, using of options for hedges or for leverage. The call override, like I said, it's a comfortable strategy. It's easy to explain to people. So advisors use it, right? So advisors kind of like a pseudo, I can still consider retail, because it's a person who's given, some amount of money to an advisor to trade. And overriding, I've had meetings with some of these, overriding is in a lot of cases the only thing they're allowed to do, right? The market is evolving, and that RIA community is getting more comfortable with well, maybe you want to sell a put spread too. And sometimes they pair these things together. There's a couple of really well-known products out there that do exactly that. They use a put spread, a long put spread against a call that's being sold. They actually do it for zero cost as a collar, effectively. So, in some cases, just simple call overriding, picking the stock or using a stock that you already have and selling calls. We don't have exact stats, because it really is, as an exchange, or the data that we have, we can't quite tell what the customer has. We do talk to the brokers, though. I would guess that the call overriding, it's not the most popular strategy, interestingly, because a lot of the retail brokerage community finds it a little bit too slow. There's traders out there in the retail world, and a lot of, since COVID, as the retail activities exploded, a lot of those people are coming in for the excitement of trading. Okay, a covered call is one of those it's a kind of a basic strategy, right? You're putting it on, you're hoping that basically the underlying goes up a little bit, but not enough to make that call go in the money. That's all you're hoping for. That is actually not super exciting, right? But the truth is, you and I have done this for a long time. That's kind of the intelligent way to invest. If you think you're going to go and YOLO your account on some GameStop calls, which plenty of people did in 2020, we know how that goes in the end. And so, the call overriding, I would guess it's probably one of the most popular retail strategies, but probably specifically among the more conservative trading community.
Oh man, yeah, you mentioned waiting. Like every time I do a covered call on some stock that only has monthlies, it's like, oh my gosh, I got to wait another 2 weeks to make this $250. Come on, please. But yeah, you're getting paid for waiting.
You are, and it's a good trade. It's funny. I think that it's a good trade if you are patient, or if you're kind of in a situation where, you know what, I want to do a trade and set it and forget it. I'm not going to pay attention. I don't want to stare at the market and see if the futures are up or down 1% today. There's times in my life where I love that, and like you wake up in the middle of the night and check the futures. And there's times, a lot more times, especially, now, I'm like, look, I just want a strategy that is going to do what I kind of understand, reflect my goals, right? I want to be invested in the market. I'm comfortable giving up a certain amount of upside in exchange for some premium. And that's it. And I'm going to do it consistently. And like, that's the key, right? Is doing things the same way, repetitively. And that's actually one of the, it's one of the reasons that the zero DTE, or the short dated trading, has become so popular. Is it's perfect for something you want to do every day. Now, in a single stock overriding, you can't, because we don't have dailies in single stocks. But there's weeklies in a lot of the more liquid single stocks, and better than it used to be. So that's kind of how I view it.
Yeah. And well, I mean, you kind of talked about a few of these points, but I mean, is covered call trading more common in individual stocks or in broad market ETFs?
I think it's probably a little bit more common in the ETFs, because, it's interesting. I guess I would say, I think it makes a big difference which stocks you're talking about, right? So, in the ETF world and the broad-based indexes, you've got a ginormous amount of passive capital that's there, right? So, I've got SPY in my portfolio that I've had for 21 years. So, having the ability to write calls against it every once in a while is very convenient. And so, like, I do it, and in the single stock world, you have a little bit more of a mix. You got people getting in and getting out of single stocks. You have some long-term holdings, people, even pension funds that might own IBM, and they're never really going to sell it. Then there's certain stocks that are, real kind of speculative stocks. And I think most people kind of, although the calls in those get, really juicy premiums, if you're talking about Palantir or MicroStrategy or something like that, right? These are stocks that could double out of the blue. They've done it before, so they definitely can. And therefore, you don't see a lot of call overriding in those. I think because in a lot of cases, people want to buy the stock and just hold on to it, or people even might just want to come in and buy calls because they really want the leverage that you get by owning calls.
Thank you for joining us and sharing your insight with us. We really appreciate it, and we'll hear from you on the next episode as well.
Awesome. Thanks, Dan.
Next week, we have a good episode here for you. We have a great episode. Next week is why covered calls work, and we're going to dig deep into the details of what are some of these things that go into an options value, and how is it that those things come together to actually make covered calls work. I'll see you in the next episode. In the meantime, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.